everybody. Welcome back to the Economic Analyst channel. I apologize for the belated upload of this video. The Producer Price Index for March 2022 came out on Wednesday morning. I was actually expecting it to be Thursday morning, and I got kind of bogged down with work later on this week, so I'm uploading this on Saturday morning. There's a lot to digest and go over on the aggregate scale of the producer prices. The Producer Price Index for all commodities increased by 2.3% this month. This was a drop, relatively speaking, from the whopping 2.8% that we saw at the end of February. But these are still really elevated high levels of producer prices. And as I've always maintained, this is letting you know upstream what's going to happen to the CPI that is downstream. So the fact that we're getting these very high producer prices indicates that we're going to get some high consumer prices downstream as these factor into the production process and the cost of inputs as businesses have to raise the prices for outputs. The real concern about this producer price index is when we take a look at the percentage change year over year. It's maintaining at this 20% plus high level, much like what we saw it maintain in 2021 before it spiked up at the end of November. And even though it's come down from that 23% back down to 20%, this high level of producer price inflation reinforces my thesis that we're going to have high consumer prices for the remainder of this year, unless if we start seeing an abrupt change in this producer price index, and I don't think that we will. We really have to go all the way back to the mid-1970s to see the annual change relative to what we're seeing now. It's, the producer price inflation has exceeded what the producer prices were increasing by 1980. And so the fact that we're having to go back all the way to the mid-70s shows how alarming this high inflation rate is. When we take a look a little bit more downstream and go into final demand, which is just consumer prices removed by one stage, final demand is showing a severe upward tick in month-over-month inflation. Final demand for March 2022 came out at a whopping 1.4%, up from 0.9% in February of 2022. This is the highest annual change in final demand inflation that we have ever seen. Of course, we only really have about 10 to 11 years of data to go back on, but the fact that we're seeing final demands year-over-year change at 11.2% reinforces that idea that what we are going to see in the consumer price index is rising inflation, probably going to tick up over 10% by the end of this year, as I have been warning about earlier. Taking a look at the trend between the producer prices and the consumer prices, we can note that starting in mid-2021, when inflation started to really take off, we saw this widening gap between producer prices and consumer prices. Now the gap has narrowed a little bit, and the two seem to be trending very, very close to each other. The spread is about 2.6% differential between the producer price final demand and consumer prices in March 2022. When we go all the way back to October 2021, we see that the spread is about 2.7%. So that's roughly been about the same. So with what we're seeing with consumer prices, as final demand starts to tick up, we can see that it's dragging and pushing up those consumer prices along with it at roughly the same rate. So if next month comes around and final demand prices have ticked up by 1%, more than likely that's going to mean that the CPI has also ticked up 1% as it keeps up with that final demand. Looking at my final demand model, of course, which hypothesizes that the last month's final demand factors into the current month's CPI, we are looking at a whopping 1.2% month-over-month inflation rate for the consumer price index. So despite the prognostications by some of the analysts that said, oh, well, core inflation was only 0.3% this month, I think inflation has already peaked. My data is not looking toward that. My data is looking in the opposite direction and saying, no, on the contrary, we're going to see a rise in this month-over-month change. And as we can see in the past, we were seeing month-over-month forecasting of 0.9, 0.8, 0.7, a little bit in 0.6, all throughout 2021. Now that when we look at 2022, first forecast for January was 0.7, then it was 0.9, then in March it was 1.0. Now we are looking at 1.2%, and this is purely based off how high those final demand prices go up, and this would result in a year-over-year inflation rate of 9.1%. Taking a look at the quarterly trend using the average and median price for the last 3 months and the change in that for the CPI is again reinforcing that the CPI is going to push over 10% by the end of this year. So unless if we start seeing a change in that trend very quickly, this will more than likely be the impact that will happen that's coming out to market right now. So the price trend is pushing up, and it's been steadily increasing from where it was in quarter four. So quarter four, the average change in the consumer prices was a positive 0.7% month over month. But when we take a look at the first quarter, it has increased to a 0.9% change month over month. So more than likely, we will see these consumer prices continue to build, and as they continue to build and increase, this will again push up that trend and point to over an 11% inflation rate that we will see toward the end of this year. When we take a look at final demand gives an even more alarming scenario. So while consumer prices were pushing over 10% and 11%, the quarterly trend for final demand is to push up to 15% by the end of this year. Now, of course, factors can change this, and I'll go over a couple of things that I'm starting to note that might give a more positive spin, but the trend is certainly building. And again, just like what we were seeing with the consumer prices, the average month-over-month change for final demand in fourth quarter was 0.7%. Now the average change is 1.2%. So again, that's going to push up that CPI, and it's going to pretty much confirm that the CPI at some point this year will push over 10%, probably late this year. Now, one of the positive things that I have seen, and this has really been a perplexing anomaly, has been the money supply growth since we've entered 2022. When we take a look at money supply growth, it has largely been flat. So take a look at the trend in 2021. We see that it has been steadily increasing month over month. And when we take a look at it from 2020, when it started to go through a huge explosion increase, and that resulted in this initial bout of inflation, we're seeing that money supply is staying relatively flat. What does this mean? Well, first off, it's too early to tell because we only have data going through the end of February. I'm really curious to see what March's data would point to. But if we start seeing this continual flat money supply growth, then later on, probably early 2023, maybe fourth quarter 2022, that would probably signal the peak of inflation, and prices will probably start to stabilize, and the inflation growth rate will start to slowly decrease over time. But it's very unusual to see a flat money supply growth rate. We really would have to go all the way back to about 2008, right around here at this breadth of the recession here in 2008, to see any type of flat money supply growth rate for 1 to 2 months. The money supply usually increases month over month over month. It's very rare when it will stay stagnant, and I'm not saying that it's going to stay flat. More than likely, it's going to increase because during this time, the Fed was still engaging in quantitative purchases. Banks were still lending out money, which gets redeposited into banks, which still relends out, which causes that growth in the money supply. So I really do think this is an anomaly, but it's something curious to note. I would say this, that if we start seeing that trend continue in March, and especially with the onset of quantitative tightening and the Fed hiking the Fed funds rate, we may actually start seeing a stabilizing inflation rate in quarter four, if not quarter one of next year. So if quarter four 2022, we still see the inflation rate peak as I expect, and increase, then quarter one, we might start seeing it to calm down and see some of these, lesser inflation rates replace this higher growth rate that what we're seeing now, and signal a stabilization in the economy if the trend holds true, because it's the money supply that more than anything else has been driving these prices. So a curious anomaly to note, but something that I haven't been able to quite put my finger on what's driving that. When we take a look at the business expense index that I have created, which again is nothing more than the producer price index and the median wage averaged together on an index level, this business expense index is running right in line with producer prices for final demand. So while producer price final demand's quarterly growth trend is showing that final demand prices will reach 15% by the end of this year, the business expense index is showing by its trend that it will reach about 16% by the end of this year, which means that consumer prices will more than likely drag up to 10, 11, maybe even 12 and 13% as we start to pick up steam on this. Now, again, these are just trends. Trends can change over time. Trends don't necessarily forecast the future, but they can kind of project out what the future will be, especially if those trends and the fundamental forces don't change. Now, right now, the fundamental forces that's pushing inflation are beginning to change. One is the Fed is beginning to hike interest rates. Two is that the Fed has ceased its quantitative easing. And three is that the Fed will probably engage in quantitative tightening, sucking out some of that extra money out of the monetary base, which might depress bank credit lending. I don't think that's what we're seeing now in this flat money supply growth rate, but perhaps we might start seeing that transition over the summer and the fall. But just because we start seeing that flatter or lower growth rates in the money supply in the summer and the fall, we still have to factor a year to 2 years before that really flushes out into the economy. And again, there's no telling if the initial bout, this initial jump, huge jump in the money supply has completely flushed out into the consumer prices yet. It may not have yet. We may be still seeing price hikes for months to come, as I've been expecting and forecasting off of my trend charts and just doing a simple projection outward. And I do think that that's going to manifest. It will take time for this tighter monetary policy to actually calm down those inflation rates. And again, interest rates are still heavily negative right now. Even though the Fed funds rate is starting to tick up, it's 0.5% when the inflation rate is 8.5%. You still have that huge negative 8% negative real interest rates, which encourages lending. You're actually getting paid to borrow money if you can take a loan out for a lesser interest rate than the inflation rate. And that kind of insidious, perverse behavior in the economy that's being encouraged by the federal monetary policies and somewhat from the fiscal policies of the federal government will more than likely mean that with more borrowing means that there's more increases in deposits, which leads to more increases in the money supply. So I will create a video on the March 2022 money supply to tell you where we stand on this. My expectation is that the money supply will have grown in March and probably resume this upward trend, so we'll probably get a sharp bounce back. But on the offhand chance that I am pleasantly surprised and we get this flat growth rate, I'll start giving some of my analysis and prognostications from then, and may actually start to place my expectations into a more optimistic outlook from this heavily pessimistic situation that we're in now. Guys, thank you for watching this video. Again, this was just looking at things on the aggregate. I'm sorry I didn't really go into the details on this, but I thought that the aggregate trends of what we're seeing in the producer prices and consumer prices were more pressing right now. Obviously, the major drivers of these prices increases are food and energy. If you like the video, make sure that you like this channel, share it on social media. If you like my content, you're always welcome to subscribe to my channel so that way you can stay up to date with every new video that I produce, giving you the latest economic information that's been going on right now and my own thoughts on where things are heading. Always click that notification bell. If clicking that notification bell, you'll always be notified when I do upload a new video, so that way you can be one of the first people to view the content. Once again, guys, I thank you for watching this video. I appreciate every single one of you, and I'll talk to you next time.